I think another interesting point is that from the JP Morgan report again, people often believe that like this company, whatever it is, I don't know, maybe Bell's a good recent example, that catastrophic losses can only happen to companies with weak financials or like overvalued companies or companies within certain risky sectors. But the reality is they happen across sectors. They happen to profitable companies. They happen to companies with moderate debt ratios and to companies with reasonable valuations. So I think that's another just important point, is that investors have to realize that any business, even a well-run and successful business, can suffer the catastrophic losses or extreme underperformance. Another interesting one from that report is that investors will use analyst consensus, and I've talked to real people who do this. Like, well, I think I'm going to hold the stock because the analyst consensus says strong buy. So JP Morgan looks at that too, and they find that the vast majority of catastrophic losers in their sample actually were consensus buys or strong buys from analysts prior to their declines. So no way to hide from that potential for loss. Going back further in time, so that JP Morgan study was going back to 1980. The 2018 Besson-Binder study, do stocks outperform treasury bills? They look at all U.S. stocks that existed in the CRISP database from 1927 through 2016. And they do find pretty similar results to what JP Morgan found. 42.6% of common stocks have a lifetime buy and hold return that exceeds 1 month treasury bills, which is crazy. People have heard those data from Besson-Binder before and from us talking about these data. But more than half the time, you're better off holding risk-free treasury bills than individual stocks over that time period, which is wild. 30.8% of individual stocks in this sample beat the value-weighted market, the index, and that's pretty similar to the JP Morgan study. More than half of stocks in the sample deliver negative lifetime returns. That one is higher than the JP Morgan study. I think that's probably because it includes all stocks in this case, including the tiny ones that are in the CRISP database that are not in the Russell 3000. It also extends to the lifetime of stocks rather than the 1980 to 2020 sample period that JP Morgan used. The data in Besson-Binder study are a little bit better at the 10-year horizon compared to the lifetime horizon. At the 10-year horizon, 49.5% of stocks beat treasury bills, and 37% beat the market. 37% beat the market. But still, like, brutal numbers if you're picking stocks hoping to beat the market. And then there's also the global skewness data. So Besson-Binder has his U.S. paper. He's also got a global stocks paper, and the skewness in global stocks is even worse than it is in U.S. stocks.
You're not making a compelling case to stock pick.
Well, I don't think there is one, really. That's kind of the idea. This is a cool paper. So there's a 2023 paper, Underperformance of Concentrated Stock Positions. They use a set of all U.S. stocks, but they exclude the smallest stocks from 1926 to 2022. The way that they describe their data is that in more recent history, it looks like the Russell 3000, but they also go back further in time when there were fewer stocks in their index, but they have a size cutoff. And then they're looking at, they take a slightly different perspective, but they're again looking at concentrated positions. So the author finds that the median 10-year U.S. single stock return in their sample is a cumulative negative 7.9 percentage points relative to the market. And that's about 0.82 percentage points in annualized terms. And also that 55% of individual stocks trail the market at the decade horizon. They also show how the volatility of a portfolio changes with an increasing weight in a concentrated position by modeling various portfolios consisting of the market index and an increasing allocation to an individual stock. And what they find, this is where that 10% being the definition of a concentrated portfolio, comes from. They find that portfolio volatility is relatively unaffected by single stock positions at weights up to 10%, but then increasingly affected thereafter. And the effects are more pronounced for individual stocks with higher idiosyncratic volatility, which makes sense. This is a really interesting data point. So if you hear all this kind of pessimistic data and think that, well, nobody would buy a loser stock, I only buy winning stocks, or I only hold my stocks that have been performing well. But this is the fascinating data point from this paper. Stocks with top 20% performance over the past 5 years have a median cumulative return over the following 10 years of negative 17.8 percentage points relative to the market. And that's an annualized 1.94 percentage points. And 60% of these stocks, as opposed to 55% of all stocks, trail the market at the decade horizon. So that's recent winners, like the stocks that, like I said earlier, I would argue are the ones that are more likely to make up a larger portion of investor portfolios. Those ones perform worse, not better, at the 10-year horizon. Pretty interesting. And that does apply, they look at in the paper, applies across all industry groups and also among both the smallest and largest stocks. So, like you said, Cameron, I'm not making a great case for investing in individual stocks. I think that the important takeaways from these studies are that positive skewness in individual stock returns means that you're much more likely to pick a loser than a winner when you're selecting an individual stock. And the effects of skewness are more extreme at longer horizons. So that means that the chances of being a successful long-term buy and hold investor with only a few stocks is increasingly unlikely at longer horizons. However, like we said, Besson-Binder cuts both ways. If you do pick the rare winners, the results can be extremely positive. And the other thing is underperformance can happen quickly, unexpectedly, and irreversibly. A lot of stocks not only underperform the market, but they suffer catastrophic losses that they do not recover from, unlike a diversified portfolio, which tends to bounce back. Now, it is worth emphasizing that it is true that a small number of stocks perform exceptionally well. It's just really hard to pick them before the fact. And the past winners are more likely to underperform than outperform in the future. So some level of diversification probably makes sense, as we know. But that's another interesting question, though, is how much diversification makes sense. So it's like, okay, individual stocks are risky, fine. So we should diversify, fine. How many stocks should you own? What is a diversified portfolio? So there are a couple papers, very, very highly cited papers from the 1970s and 80s that find kind of a 20 to 30 stock portfolio is sufficient for diversification. And the way that they approached it is that beyond that point, the risk reduction benefits diminish. Now that 20 to 30 stock finding has colored the beliefs of many investors. But I think that the problem with it is that it assumes that volatility is the only measure of risk that matters to investors. So they kind of show that the volatility reduction benefits of additional stocks levels off after 20 or 30. But I would argue that what matters to investors is the expected distribution of long-term wealth outcomes, not the short-term volatility. So if you think about like a more concentrated portfolio has a small chance of holding the mega winner and a much larger chance of holding the losers. But if we look at even if they have similar volatilities, I don't know if they would, but say they have similar volatilities, the difference in wealth accumulation between the worst and best concentrated portfolios is going to be huge. It's going to be enormous at long horizons. So reducing volatility is for sure a good thing. That's one of the things that diversification can help with. But the other interesting thing is that at very long horizons, even small differences in volatilities can have big impacts on long-term wealth accumulation. All right, so.
Really interesting.
Yeah. We talked about this in some of our earlier, way back episodes about concentration versus diversification in factor investing, We talked to Wes Gray about that.
Wes Gray, exactly.
Yeah, it is a very interesting topic. So there is a 2022 study by Roni Israelov, How Many Stocks Should You Own? So they simulate long-term wealth outcomes for portfolios with varying levels of concentration. And they find that the 25th and 10th percentile outcomes, so basically the worst outcomes in their simulations, improve quite dramatically until around 250 stocks are included. And then the incremental benefits of diversification really decrease after that. The average portfolio in their simulations multiplied wealth 19 times over 25 years on average. But an investor with just 25 stocks had a 1 in 10 chance of receiving less than a 12 times multiple. An investor with 250 stocks had a 1 in 10 chance of achieving less than a 17 times multiple of wealth. So you can see that distribution is a lot wider. The left tail is a lot worse with a more concentrated portfolio. The worst outcome is less bad. The best outcome is also less good, which is interesting because that's not necessarily a good or bad thing. It does make the choice about how diversified a portfolio should be a preference more than a prescription. You can't just say, well, you should have this many stocks. But I think it's worth highlighting that when risk is measured as the variability of terminal wealth, the diversification benefits of adding more stocks does continue far beyond that 20 to 30 holdings that sometimes get cited. If you're confident you can pick winning stocks before the fact, portfolio concentration can make sense, but the odds are stacked against you. And the track record of active management in general does leave much to be desired, as we know, and as we mentioned with Besson-Binder's research. But it is worth saying that some investors may be comfortable with that risk. They may be willing to accept a wider range of long-term outcomes, including a good chance of trailing the market or even suffering a catastrophic loss in exchange for a smaller chance at extreme outperformance. It's like a preference for a lottery-like payoff, which you can't say is right or wrong, but I think it is just a risk that needs to be properly understood for anybody holding a concentrated portfolio or for holding a single stock. In Besson-Binder's Do Stocks Outperform Treasury Bills, he simulates long-term returns for 20,000 portfolios of randomly selected 5, 25, and 50 and 100 stock portfolios. And he finds at the 10-year horizon that even 100 stock portfolios outperform the market only 47.5% of the time. That was a crazy finding from his paper too. Now, there are a few different ways to interpret that result. One way is that, well, hey, it was only a little worse than a coin flip, that you would have beaten the market before costs. The other is that you had more than a 50% chance of trailing the market. Now, the nice thing about total market index funds, and even I think I would group dimensional funds into that category because they still own that broad cross-section of all the stocks in the market. The nice thing with that approach is that you know you're going to get the market return, in the case of dimensional plus or minus some factor premiums. But you know you're going to get the market return even if you don't know what the market's going to be. With a really concentrated portfolio, you might still get the market return, but it's going to be plus or minus the active return from portfolio concentration. And that range of outcomes for the active return is going to be a lot larger with increasing portfolio concentration. And the distribution of outcomes of all the concentrated portfolios is going to have lots of losing portfolios and a few big winners. And that skewness will decrease as you increase the diversification of the portfolio. There is research from Vanguard showing that active share, which is not the same thing as concentration, but it is related. And we actually have an episode with Martin Kramers, who created that measure, coming up. So that Vanguard has research showing that higher active share results in a wider dispersion of benchmark relative returns for actively managed funds. Anyway, so it just becomes a question of how confident you are that the stocks you pick will be winners rather than losers, while keeping in mind that the distribution of individual stock returns is pretty intimidating. Another interesting point here is that portfolio concentration can have asymmetric effects on performance. There's a 2022 paper, Fund Concentration, a Magnifier of Manager Skill. And the authors there find that, or I think it's a single author, the author finds that increasing concentration has a pronounced positive impact on performance for outperforming funds, which kind of makes sense. If you take more concentrated funds that have done well, they will have done well more so than more diversified funds. But the opposite is true for underperforming funds. And this is a really interesting point, though. Higher levels of concentration generally hurt the poorly performing funds more than it helps the outperforming funds, right? This is another interesting point on the concentrated positions thing. Like we talked about a few different paths that you could have taken to end up with a concentrated position, but most of those paths lead to both or some combination of economic and psychological barriers to diversifying. I think the biggest economic barrier, we talked about this earlier with the Nortel example, is taxes. If you own a stock that increased in value substantially, leading to it being a concentrated position, there's probably a large tax bill associated with selling it. So I think an important thing to think about in that case is that the taxes generally don't go away, at least not in Canada. In the US, there can be some estate planning. But in Canada, the tax bill doesn't go away. The only thing you can do is control whether you sell, whether you realize the gain now or later, because it's coming no matter what. Now, deferring taxes can be a good thing. But in this case of a concentrated stock position, it is being traded off against taking a large amount of idiosyncratic risk. There are some strategies in Canada, like tax efficiently donating the appreciated securities, that can make sense. But that's like, if you were going to make a donation anyway, then this can make sense. Donating them for the sake of donating them when you wouldn't have otherwise, well, that's not really helping you with your tax bill. I mean, I guess it sort of is, but you're also giving away the asset, so it's not. But if you're going to make a donation anyway, this can be a very tax efficient way to do it. But that said, it's a relatively complex planning, and it's got to be approached very, very carefully and in the context of the overall financial plan. Another less common economic constraint that can still be relevant is control. Some large shareholders of a company that have a concentrated position may need to maintain their large position in order to maintain voting control of the company. That's obviously a much harder one to overcome. The psychological constraints to diversifying include the representativeness bias, where people ignore the types of base rate probabilities that we've discussed in this episode, and assume that their past performance with a single stock is indicative of its expected range of outcomes. There's also the endowment effect, where people prefer things that they already own. There's the status quo bias, to stick with the thing that you're already doing. I own this stock, so I'm just going to keep holding it. It's easier to not make a decision than it is to make one. And in the case of a stock that's fallen in price, we also have the disposition effect. So managing those biases with respect to diversifying a single stock position can be challenging. A couple of things that can help. One is imagining that the amount you have invested in the single stock is in cash and asking yourself if you would buy the stock today. And then another one, and this is one that I got from someone who I told the first one to, and they kind of took it away and thought about it, and they came back and said, I tried doing that. I tried imagining that it was cash, and I wouldn't have bought it, but it didn't help me sell. I was still stuck. And so they came up with something that did work for them, which was creating a systematic plan to dollar cost out of the concentrated position. So it avoids the psychological impact of making one big decision and having it not work out.
Makes sense. I'm still in the cash camp. I find that one pretty effective.
I like that model too, but it doesn't work for everyone. And if it doesn't work for someone, and the other dollar cost averaging out, if someone says, I just can't do it, I can't sell the whole position, I like putting something systematic in place.
Yeah. It's tough being a human.
Yeah. What's tough investing as a human. Humans are not designed to be long-term investors in these abstract financial instruments that we call stocks. Okay, so stocks are extremely risky, as I hope we have articulated. Most of them, by number, underperform the market. Many of them have negative long-term returns or, more extreme, catastrophic losses. And a smaller portion of them have extremely high returns. Picking any one stock is more likely to lead to a bad outcome than a good one. And counterintuitively, from one of those papers, that is even more pronounced for stocks that have performed well over the last 5 years. So the simple answer is to overcoming individual stock risk is, of course, diversification. the extent of diversification that makes sense depends on your preferences for skewness. Some people might want skewness. Also, your conviction in your stock selection ability and your willingness to bear the risk of a wider range of potential outcomes. And then getting out of a single stock position, it can have economic and psychological challenges, but I think those can be overcome with thoughtful planning. And that's something that we've seen many clients do.
All right, you've convinced me. Mission accomplished. I'm a changed person because of this.
Glad you're convinced. You're going to go sell all of your Tesla and Nvidia shares?
That's right. I'll get on that right now.